What's going on? Welcome to session 2 of your Strategic Trader on Demand content, where we really now are going to dive into market foundations. And market foundations are an important element because we really want to understand what is a market. And that's ultimately what we're looking at, right? In this session, we're going to talk about what is a market and really how does it work. So, session 2 is all about the foundations, right? We want to begin at the beginning and really get our foundations straight for what is a market. So let's ask that question. What is a market? Right? Well, the definition of a market, as far as I can tell, is any place where buyers and sellers come together and transact. Now, you might think that I'm just talking about the stock market, but it's not just the stock market or the options market or the futures market. It's really any market. So let's talk about how every market, operates. For this example, let's talk about a fruit market, right? Let's talk just about a fruit market. So when I'm talking about a fruit market, that's an easy one to think about because think about the fruit market itself. There are really 3 parties to consider. And a lot of people say that they only consider 2 parties. They talk about the buyers and the sellers, but that's not it. Because the buyers and the sellers are not the marketplace. Right? There's an owner of the market. So if you think about a fruit market, so where I live in a town in Houston, Texas. And so let's say that there's a Houston farmers market. Can anybody go onto that market and sell stuff? No. Matter of fact, they've got to pay the owner of the market. So let's say that the owner of the market is Houston City Parks Society. So the Houston City Park Society is the one who puts on the market. So in order for you to have a booth at the farmers market, you've got to pay the Houston City Park Society. Now, the Houston City Park Society doesn't really care what price that you sell your corn. The Houston City Park Society doesn't care what price you sell your honey or your wheat or your zucchinis or whatever you have. They don't care about the price. They just care that you're there, right? Because they're selling spaces. Well, that means it's the market's job, right? It's the market's job, the exchange's job to go out and find buyers and to put together a program to attract sellers. Well, what attracts sellers? Well, what attracts sellers are going to be buyers, right? That are selling at a good price. So if you think about the market itself, the actual fruit market, it exists for one reason and one reason only: to facilitate transactions between willing buyers and willing sellers. That's the only reason that a market exists. It's to put together someone willing to buy and someone willing to sell in a transaction. So when we think about a market as a destination, right? A market is a destination. When somebody says, hey, it was a good day in the market, it was a bad day in the market, what they really mean is that it was a good day for the index. And we'll talk more about indexes or indices in further sessions. But I don't care if it's a fruit market, right? The prices in that market, a fair market and an open enterprise is going to allow the market to determine what the price should be. Because if you put your carrots out there and your carrots are out there and they're too high of price, no one's going to buy them, right? No one's going to buy them. If they're too lower priced, you're going to run out of carrots too quickly. So all markets are in search of fair prices where buyers and sellers are equal. Same thing with a car, right? People think about a car. Now, is a car dealership a market? I would say no. A car dealership is not a market because in a car dealership, the buyer is going to the seller, right? The buyer is going to one seller. A car auction would be an actual market where there's many sellers who show up and there's many buyers who show up. And now, the auction house itself controls who comes in and who buys and who sells, right? They've got control over the buying and the selling and who's there, but the auction house doesn't care what price you sell the Mercedes for. The auction house just cares that there's enough sellers to sell the product and enough buyers to buy the product that they can continue to sell access to the market, right? So same thing happens in the equity markets or the currency markets or the stock markets. The exchanges themselves, the markets themselves, they really care about attracting buyers and attracting sellers. So think about this, and if you're taking notes, write this down. Markets exist to facilitate trade. They only exist to find fair price value areas where buyers and sellers will be willing to transact, because without that, the market is just not useful. Now, on the market, there's really only two actions that can be taken. There's the buying and the selling. Now, some people would say, well, can I buy and hold? Isn't that an action? I would actually say hold is the definition of inaction, right? And the buying and the selling, and this is a good picture here because it shows two men arm wrestling, but that's really not the case. When they buy and they sell, it's more like they're coming together and in agreement. It's not the buyers versus the sellers. It's the buyers agreeing with the sellers that we have reached a fair price. Now, where this happens is on an exchange. So the exchange is where the actual buying and selling takes place. An exchange is defined as an organized and regulated financial market where securities are bought and sold at prices governed by the forces of demand and supply. That's what it is, right? It's an organized and regulated. Those are two key words, because if the exchange itself is not regulated, then it becomes kind of the wild, wild west. But it's an organized and regulated financial market where the securities, whether that's bonds or notes or shares of stock, are bought and sold at prices governed by the forces of demand and supply. Now, here's the key. It's governed by the forces of demand and supply. They're not set by anybody, randomly. The forces of demand and supply will govern whether prices go up or go down. Now, the purpose of that exchange is to facilitate orders actually getting filled. And there are literally dozens of exchanges, right? Whether you're talking about the London Stock Exchange, the CME Group, the NASDAQ, the CBOE, the New York Stock Exchange Archipelago, the BATS, they're all different exchanges. And every exchange exists for the facilitation of trade. Now, when we think about an exchange, oftentimes we think of this picture here with a lot of, people in the pit. This area down here is called a pit. And in that pit, this is where there were people buying and selling, right? Buy, 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 sell, sell, sell. And they're waving pieces of paper and they're throwing them all over the place. Well, and this goes back even to 2015, the CME Group to close most Alpine Outcry futures trading pits in Chicago and New York in July. Matter of fact, they've all closed it since that point. There's really no more physical trading on the floor in reality. But let's talk about when there was, because when there was, it's still, people, they were buying and selling, they would fill out what are called order tickets, right? And I like the concept of thinking of these order tickets. And an order ticket would be a buy order or a sell order, right? So they could fill out this order ticket, which is to buy or to sell. And what you would have is you would have sell orders above current price, right? Now, this is how an exchange would work before an electronic communication network, is that in any given security, there would be an inventory of unfilled orders. There's an inventory of unfilled sell orders that would be sitting there above current price, waiting for those sellers to trigger when price gets to that region. There's also an inventory of unfilled buy orders, typically below current price, where you have a stack of buy orders. Now, think about the market, what it exists to do. The market exists to facilitate trade. It exists to get those orders filled. So when we think about these order tickets show how many shares are being traded, and it's placed ahead of time. Now, the way that this worked in a market, if you think about it, was that a clerk would take a phone call, or a clerk would take an order and fill out that order ticket. And that clerk would then sit on that order ticket until price came into the area of that ticket. The clerk could then give that ticket physically to a runner, right? And the runner would literally run the order to the traders out there on the floor. And then the traders would see what price the market maker is buying and selling. And if their order ticket came up and it said, let's buy 1,000 shares at 50 and an eighth, because this is way back in fraction times, but let's buy 1,000 shares at 50 and an eighth. And when the market maker gets to 50 and an eighth, you say buy, 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 buy. and you got your 1,000 shares, well, there's got to be somebody else willing to sell 1,000 shares, right? And there's hand signals, and there's yelling, and there's screaming. All that went away. All that went away, right? All that went away when electronic communication became really the norm and the staple, because it was so much more efficient and it was so much faster. But the order tickets themselves didn't go away. Neither did the fact that those orders get placed ahead of time and that there are still, for the lack of a better term, stacks. And I'm using the term stacks because at one point there were stacks of paper. But, for the lack of a better term, there's still stacks of orders around current price. Above current price, there are typically stacks of sell orders. Below current price, there are typically stacks of buy orders. And when we think about that, you'll see this picture a lot where we talk about the sell orders above current price, the buy orders below current price, and those sell orders will typically be in red, and the buy orders typically going to be in green. Now, this was before electronic communication networks. Once we started to see electronic communication networks come into play, now people had the ability to fill out an order ticket from home. They didn't need to pick up the phone and call a broker or call a trader or have somebody run the order down to the floor. You could just push buy on your computer. And these electronic communication networks are a system of interconnected computers that transmit orders through to a centralized exchange. Matter of fact, NASDAQ is an acronym. It stands for National Associated Securities Dealers Automated Quotation System. The NASDAQ is a completely electronic exchange connected through electronic communication networks. What's funny is here's an article that was in 2003, and it said, until electronic trading systems can replicate all the functions of a floor-based system in human intermediaries, a role remains for floor-based trading. Well, what has happened? The stock market is now run by computers, algorithms, and passive managers. The market is run by computers, algorithms, and passive managers. It's completely taken over. But here's the best part. Those orders are still placed ahead of time. The market itself fundamentally hasn't changed. A market still exists to facilitate trade and to find areas of balance between buy orders and sell orders. So when we think about these buyers, we've got to really focus on what makes a buyer buy a particular security. Why are they buying, right? If I'm a buyer, what's my purpose for buying? Well, there's really three reasons that buyers buy anything. And I don't care if it's bananas or if it's stock or if it's a new car. They buy for consumption because they want to consume whatever product that they're utilizing, right? So they'll oftentimes buy for consumption. Why else will they buy? Well, they'll buy for protection, right? And if they buy for protection, what they're doing is they're buying to protect an investment they already have, right? Sometimes that's going to be the case of insurance. Or they buy for appreciation expectations. They think prices are going up, right? They want to buy it because they think it's going to appreciate in value. Well, why do sellers sell? Sellers will sell really for three reasons. Number one is cash liquidity, right? They sell something because they need the cash. I need to get the cash for that particular investment. They sell to take profits, right? Maybe they appreciated some expectation. They had appreciation expectations, and it has gone up, and they want to take those profits, so they'll oftentimes sell. Or they sell because of depreciation expectations. They think it's going to lose value, right? That would be the three reasons why they would sell. So when we're talking about a financial market, we're not really worried about consumption, right? From the why buyers buy, but really all the other reasons still exist, right? They might buy for protection to hedge a position. They might buy for appreciation because they think it's going up. They might sell for cash liquidity because they think it's going down. Or they just need to free up some cash in their account, maybe free up some margin. They might sell to take profits, and they may sell because they think it's going down. Buyers buy and sellers sell for those reasons primarily, right? Now, consumption, not quite as much in the financial markets because there's really not a lot to consume. So when we think about those prices, they move up, they move down due to the buyers and sellers. So why does price move up? And the thing I most often hear is that, well, it's because there's more buyers than sellers. Is it though? Is it because there's more buyers than sellers? See, here's the thing that I want to say is that it's the lack of willing sellers at a given price that causes price to move up. The lack of willing sellers at a given price is why price moves up. Think about it. If you live in the best neighborhood in Los Angeles, a $100,000 house, just there are none. There's a lack of willing sellers at that price, right? You've got the prices are going to continue to go up until you find a willing seller who's willing to sell at that given price. If there's, just saying more buyers than sellers doesn't really tell the story. Now, by the way, by the same token, what if there's no buyers, right? What if there's no buyers? Well, if there's no buyers, or there's a lack of willing buyers, but you do have willing sellers, well, then price is going to go down if there's no willing buyers, right? So we got to think about the lack of willing buyers or the lack of willing sellers. And really, I like to think of them more as inventory, right? Consider them more like inventory. So let's look at an example here with our newest widget. And our newest widget that we have here, it's the hot item for Christmas. And the only way that you're going to get one of these hot items is if you are right in front of that market and to get it on the secondary market, right? Well, Mary's pretty smart. Mary saw this coming and she bought 4 widgets. And she bought 4 widgets for $20 a piece. And she put them on eBay for $100. Now, Mary's the seller, right? She represents the seller and she has inventory to sell. She has 4 units to sell and she's got them listed at $100. Well, it's eBay. It's an auction market. So here come the willing buyers. You've got 4 willing buyers, each of them willing to buy 100, and they show up in order. And then you get 4 more willing buyers, one at 105 and then one at 110. So let me ask you this. If you're Mary, who are you going to sell to first? Well, your first widget is going to go to your first willing buyer who's willing to pay you 110, right? The person who's willing to pay the most. Now, what about the second widget? Well, the second widget's going to go to my second willing buyer who's willing to pay for 105. How about the third widget? Well, my third widget's going to go to the first guy who got in line, who's willing to pay 100. And my fourth widget goes to the next young lady who got in line willing to pay 100. So now Mary has no more widgets. We have no more willing sellers. So when there are no more willing sellers, but there are still willing buyers, price then goes up. So Mary now puts it on eBay for 120. So here's the question. Do I have any willing buyers at 120? No, all my willing buyers are still at 100. So if those 4 get filled, right, those 4 may or may not get filled, Mary might have to lower her price again. Because if there's no willing buyers at 120, the price is then going to go down. And by the way, this is the way every market works. So as we start to go through your education, you're going to hear me use terms like fair price value. You're going to hear me use terms like willing buyers, willing sellers. You're going to hear me use terms like unfilled order inventory. But it all comes back to the fact that a market exists for one reason: to facilitate trade, to find a fair price between buyers and sellers. So if you have any questions, send us an email, support@TradersArmy.com, or feel free to shoot us a text. I know this can be a little bit of a heavy subject, so we're here to help you if you need anything. Thanks so much. I'll see you in the next session.